Well, it's happening. The Financial Times just dropped the headline, and I quote, "The New York Fed held a meeting with banks over a key money market lending facility, amid Reuters reports of growing worries about tighter market liquidity." If you've been with this channel, if you've watched our last video, does this sound familiar? So this isn't a routine check-in, this is a "the plumbing is on fire" meeting. The official narrative is finally crashing into the reality we've been tracking for weeks. They aren't meeting because they are proactive, they're meeting because they are reacting. Reacting to what, you may ask? Reacting to this. In our last video we showed you the Fed funds rate breaking above the Fed's own target last month. Well, guess what? As of yesterday, November 14th, it is still happening. The Fed's target is 3.75% to 4%, but the actual effective rate is trading and approaching the 4% barrier. The 10-year Treasury bond yield is already increasing. They cannot control it, and here is the proof the market is asleep. Just look at the Fed funds futures. In late October, the market was pricing in a 95% chance of a rate cut on December 10th. As of today, that probability has collapsed to just 43%. Do you see the conflict? The market is again pricing higher for longer. At the exact moment the Financial Times is reporting on panic meeting and the plumbing is breaking. This is the tension, and this is also the trap. They have lost control, and the market is looking at the wrong way. So what does this mean for the S&P 500? The market is still priced for soft landing. It is still thinking Fed pilot is bullish. This is the first order 2020 mindset thinking, and it is dead wrong. A liquidity crisis, a credit event, is never bullish. This isn't a voluntary pilot to save stocks. It is forced pilot to save the system itself. So let's look at the chart. The market is ignoring the plumbing. It is ignoring the Fed's panicked meeting. It is sitting here at 6,750, right on the top of the consolidation channel range that's held since July. This is the moment of truth. That 10 to 20% drop we've been modeling, what does this look like here? The immediate critical support is the floor of the entire range, right around 6,600. When the market finally connects the dots that this isn't a pilot, that this is a break, that is when we break support at 600, and there is a lot of air below there. A 10% correction brings us down to 6,100 to 6,200 zone, which is the next major structural level. A full 20% panic, however, that takes us all the way down to the roughly 5,400. That is the base case if this liquidity crisis finally gets priced in. So here is the framework. This meeting isn't the end of the story, it is the start of the public panic. We have a path A, the breakage. Watch for an announcement from the Fed, a new facility, a new lending program, for example. And that is the signal that the first order panic we've been worrying about is here. We have also path B, the debasement. That is the second order effect. They will have to print, but they will only print after something breaks. First the pain, then the debasement. The Fed is trapped and they just admitted it. And if you need one final piece of confirmation, it just broke. President Trump has just disclosed his new trades. He bought at least $20 million in bonds and at least $1 million in the bond market. So let's apply our filter. He isn't buying higher for longer. He is betting on the Fed's official narrative. He is betting that the Fed is trapped, and he is betting that the pilot is forced. He is prepositioning for the debasement. The smartest money in the room isn't listening to the Fed. They're watching the plumbing just like we are. This story is moving very fast, and subscribe and hit the notification bell. I'll be back as soon as the data updates. Take care.